at the right time.
Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Harsha Subramaniam.
Good afternoon. I'm Ira Dugal. Let's get to the headlines. Indian markets stayed in a tight range. IT and pharma stocks lead the gains. Mid-cap index continues to outperform.
India's manufacturing growth eases, slips in August on softer domestic demand.
The Supreme Court stops construction activity in Maharashtra, Madhya Pradesh and Uttarakhand and Chandigarh, citing a lack of solid waste management policies.
Mixed bag for automakers in August, with market leaders like Maruti and Hero MotoCorp seeing a moderation in sales. Others like Bajaj Auto and Tata Motors post robust numbers.
Voices coming up on the show today. JP Morgan's Sajid Chinoy and his view on the GDP growth data. We'll get you that. We'll also get you a voice in on the implications of the Supreme Court's construction ban. Niranjan Hiranandani spoke to us earlier. We'll play you a bit of that.
But first, the markets. IT and pharma stocks, interestingly, are leading the up move thanks to the rupee. Neeraj is here, as always, with a closer look.
Hey, hi guys. So, yeah, I mean, the headline sums it up. It's essentially got to do with the exporters, predominantly pharma. Really, IT has got the presence of Wipro, but that's on a news peg. On the largest order win that they've ever won, though remember it's a 10-year win and companies tend to do this quite regularly. So yes, it's up about 4%, but pharma is the main driver in the session today. Everything from a Reddy's to a Sun Pharma to a Lupin are doing extremely well. Sun Pharma, remember Rasha, this news bit about how there were no observations when the USFD was auditing the Halol unit as well. It's a Bloomberg Quint exclusive, of course, but I think that may also be helping the stock a little bit in the session today. If I just take a glance at what's happening at the broader end of the spectrum, the auto names aren't necessarily reacting too negatively. The 2 or 3 which came out with the names which are not too good, Maruti, for example, just down about 1%, because I think this one odd month, it doesn't signify a trend. Incidentally, companies which have done well, Ashok Leyland, for example, robust sales, and that stock is doing well. Two-wheeler companies, Bajaj Auto, TVS Motors, etc., came out with good names. I think good numbers, and those are doing okay. And real estate companies, one would have thought that this ban would spell sentimentally bad news. Oberoi Realty is up about 3.5% in the session today. So good going really all round for the mid-cap end of the market too, despite the fact that it's a very flat day of trade today. Last but not the least, if I look at the small cap or the BSE small cap space, just one name that I do want to point out, and that's Balkrishna Industries. Very strong name, usually tends to do well, very conservative, but they've come out and announced a very large capex plan, and that has led to some bit of selling in today's session. Volume is substantially higher than what the 20-day average is for Balkrishna Industries as well. So from a slightly larger but a small cap stock perspective, BKT is the one to watch out for today.
Interesting. That's the markets for you, Neeraj. Thank you so much for that. Let's focus now and talk about what's happening. Manufacturing activity growth slowed down for the second consecutive month in August. The Nikkei India Purchasing Managers Index, or the PMI, fell to 51.7 in August from 52.3 in July. That's according to a statement by the IHS Markit that compiles this index. A reading below 50 indicates contraction in activity, while a number above it signals expansion. Manufacturing activity in the country has remained above the 50-point mark for the 13th consecutive month, led largely by strong underlying demand. That's the PMI for you. On the other hand, India's economy returned to 8% growth for the first time in 2 years, supported by what was a positive base effect. However, economic conditions have also steadily improved as the impact of demonetization and GST have started to fade. Ira standing by with the fine print of the first quarter growth data. Ira.
All right, I think a lot of attention has gone into the 8.2% number that we got, and absolutely justified. We have not seen these kind of growth numbers for a while. I know the skeptics said it was base effect, but you know what, guys, it wasn't entirely base effect. So let's give the economy its due credit. What you got was 8.2% on GDP, 8% on GVA. Yes, there was a base effect built in, but remember, all economists had already accounted for that. And despite that, the Bloomberg consensus number was at 7.7. Within that bucket of economists, there were people like Shugato Bhattacharya of Axis Bank who had predicted 8.2%, Shubhda Rao of Yes Bank who had predicted 8%. So, there were people who were building in some inherent economic strength, adding to that base effect, and that's exactly what happened. Now, everybody's had 2 days to look at the data, and people are slicing and dicing it various different ways. We'll give you one interpretation and then, perhaps allude to some of the other ones as well. If you just look at the very broad agriculture, industry, services breakup to see where the strength is coming in from, you've got a sense that this time around pretty much everything played along. So agriculture at 5.3 was stronger than what people were expecting. There was an uncertainty about how the agricultural number will shape up. There always is, but at 5.3% on a 3% base, agriculture played along well. You had industry at 10.3, but yes, there was a very strong base effect because you'd seen no growth in industry in the same quarter last year. And then, of course, services played along as well. In fact, some people have chosen to focus on the services number because the 7.3% services growth came actually on a very high base. So you had strong growth in services, which has also been indicated by the PMI numbers, and then you had industry play along. Just stay with this chart for a minute because, I just want to briefly tell you that within the industry segment, you had the employment generating sectors, construction do very well. So, there is that element to it as well. And then those who sliced and diced it up in a way to look at government-led growth and private-led growth also came away with the impression that the private sector has started to play a role, and the core GVA has improved from 7.2 to 8.1%. So no matter which way you slice and dice it, this number was certainly good. If you look at the expenditure side, again, you'll find very little to complain about, except the fact that perhaps consumption is growing a little too fast. And that may be something to worry about in the future quarters, but gross fixed capital formation at 10% growth continued its run, showing that there is a modest investment cycle in play. It may not be the power capex, it may not be the steel capex, but it is capex nevertheless. Private consumption, 8.5% growth. Now that's a number you want to focus on, but you want to take a little bit, sort of focus on that also from the risks point of view, which we'll come to in a minute. Government consumption at 7.5 slowed, but that's okay because, we don't want the economy too reliant on government consumption, which then brings us to what the rest of the year will look like. This number will probably bring some upside risks to the 7.4% FY19 GDP growth target that the RBI has put in. So people are now talking about a number around 7.5 and perhaps, some saying the bullish one saying closer to 8%. But Q1 GDP will be a high. The base effect will start to wear out. So Q2, Q3, Q4 will not look as buoyant as Q1 did. Keep that in mind. But also, if high growth continues, then you have a risk of a third interest rate hike coming in very much, not just on account of the currency factors, etc., but just on the underlying growth inflation risks. The MPC may be, thinking a little bit more of a third hike, given the kind of growth rates that we've seen. But of course, as everyone has pointed out, the big risks to the economy continue to be current account deficit and the external risks. On the current account deficit, in some ways, it links back to that very strong consumption number that we got, because that consumption number is feeding into strong demand for consumer items, iPhones, etc., 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 and that is adding to the current account deficit risk, along with, of course, oil, which remains the biggest wild card and the biggest factor that we have to watch.
Interesting that, Tira. Thanks for that, putting that in perspective. Well, continued growth in consumption and early signs of exports revival is Sajid Chinoy's biggest takeaways from the latest GDP print. The chief India economist of JP Morgan does not expect growth to sustain about 8% for the rest of the year, but he believes that 7% is pretty healthy. Listen.
The glass is half full as yet, at least. A very strong GDP print, as you mentioned. To be sure, there was a very favorable base effect here that helped, because the corresponding quarter the previous year growth was at a multi-year low. So it was helped by a favorable base. But notwithstanding that, this is still a strong print. Two things for me stood out. One is consumption in India continues to hold up well, which is music to policymakers' ears. But I think more importantly, for the first time in many quarters, exports began to grow stronger than imports. So the drag from net trade was much lower, and that's early tantalizing signs that the rupee depreciation, which we've seen over the last 6 months, may be showing up now in terms of boosting real activity. So I think it's a good start to the year. There are many risks to growth down the line, but policymakers will certainly take a print like this to start the new fiscal year.
The question is whether that 8% growth is sustainable for the year.
I think that would be very difficult to sustain. For one, I think, as I mentioned, the base was very favorable here, and as the year goes on, the base does begin to normalize. So you'll see this optical deceleration in year-on-year growth numbers. Quite apart from those statistical reasons, there are meaningful headwinds to growth. India is a very large importer of oil. If oil sustains above $75 a year, that will be a negative terms of trade shock for the economy compared to last year. And secondly, monetary conditions around the world and in India are tightening. That's going to be a headwind. We're also undergoing an important, necessary bank deleveraging. So these will be meaningful headwinds to growth. If in this global environment, India can sustain, growth at 7.3% for the year, which is our forecast, I think we'll be doing very well, given how much other emerging markets are struggling for growth.
And Sajid, is this enough for the RBI to perhaps bring forward any sort of tightening that might have been on the table?
The RBI, I think the October meeting becomes an interesting dilemma. Having moved in two back-to-back meetings, most of us thought the RBI has bought itself the time and space to wait the October meeting out. Also, headline inflation is coming down. We expect the August print, which comes out next week, to be below 4% because food prices are muted. But I think the key here, the joker in the pack, is the currency. We've seen all emerging market current account deficit countries come under pressure the last 2 months, despite a weaker dollar index. And if that continues, and like other emerging market central banks, the RBI is losing reserves at a rapid pace, then I think the October meeting very much comes into play, and a strong GDP print basically enables that. So I think this will come down very much to the movements in the Indian rupee over the next month. I think what we're seeing around the world is markets are increasingly placing a significant premium on central bank orthodoxy, and I think the MPC will not be immune to that.
Yeah, just to pick up on one of your thoughts there, if I'm an FX trader and I'm sitting here and I can nitpick on India because of that current account deficit, but equally you mentioned that exports have started to pick up, maybe as a function of the weak currency. Can the currency weaken enough, though, to move the needle on that one? In other words, can it get India out of that current account deficit that it has?
Not immediately, but a few quarters down the line, we think. I think it's important to put this in context. The trade-weighted rupee currency appreciated 20% between 2014 and 2017. In our view, that contributed to the current account widening to these levels. In the first 6 months of the year, it's given up 6% of that. So I still think there's some work to do on that front. It'll probably take several quarters for the current account to go back to sustainable levels, which means in the near term, you need a combination of three things. We've got a large buffer stock of reserves, significant reserve adequacy, so the central bank will have to use its reserves to ensure that there's no disruptive move, but also policy needs to stay orthodox. We need a little more monetary tightening, and most importantly, the fiscal needs to be on course. The government needs to ensure that the targeted fiscal consolidation is achieved. The combination, I think, of a weaker currency and tighter fiscal and monetary policy will get us through this year, but you need all three levers to be pulled.
Sajid, India is still short of FDI. Do you see the government doing anything to reverse the situation?
To be fair, the government's done a lot on the FDI front in the last few years, and if you just go back to 2014, FDI in absolute numbers used to average $20 billion a year. That's gapped up to about $35 billion a year. I think now the key is going to be when the domestic private investment cycle picks up, because in the past we've seen FDI is very strongly correlated to domestic investment. When domestic investment picks up, you'll automatically see more FDI. And for investment to pick up, I think the deleveraging that we're seeing in the banking system needs to take its course. We need to wait a few more quarters, maybe a year or two, to ensure these twin balance sheets have been cleaned up, bank balance sheets and corporate balance sheets. I think that will lay the ground for the next round of private investment.
And just very quickly here, Sajid, what's your estimate on potential growth here? In other words, give us an idea where the output gaps are, very quickly.
I think the potential growth is above 7%, 7 to 7.2 at this point in time, which is why with growth picking up above those levels, core inflation has gone up, and I think it'll require more private investment in the years to come to boost that level from 7 to 8. Let me just end by saying this: in this world, 7% potential growth is pretty healthy.
Right. GST collections fell in July, partly due to the lower rates. The total collection came in below 94,000 crore, a drop of nearly about 2,000 crore versus the previous month. The Finance Ministry cited the GST Council's decision to cut rates on certain products on the 21st of July, which prompted consumers to perhaps postpone buying by a few days. According to the government, compliance has gone up with about 67 lakh GSTR 3B returns being filed for the month of July.
All right, let's connect back to the markets. Another 1,000-point milestone is within reach for the Sensex. While economic growth is aiding optimism, lingering external risks and stretched valuations are raising concerns. Ravil Shirodkar of Bloomberg News has put out some charts to explain what's going on and what the connection is. Valuation is clearly the pain point. Take us through the milestone first.
Well, look, we had the Sensex reclaiming the January high in July, at a time when few would have expected it to rebound from this year's lows in March. And since that time, we've cleared 2,000-point hurdles in quick succession, and we are closing in on the third. So all that's very good. You have a great set of GDP data providing a good backdrop, but we're not really off to the races yet. So the whole idea of was to show readers, through charts, what are the metrics that are still warning, are still flashing signs of concern.
Talk us through some of those metrics. The valuations on mid-cap particularly is something that you've highlighted. Yeah,
the mid-cap bore the brunt of this year's sell-off. Now, despite that, the valuation premium that the mid-cap index commands vis-a-vis Nifty is still significantly high, given the this year's underperformance. So it basically reflects that any optimism over their growth prospects is already priced in. You wouldn't have expected the mid caps to quote at a valuation premium, considering the carnage that you've seen in that space this year. So that's one. The second metric would be our own premium. India's always traded at a premium to emerging markets. The problem is now you had the valuation premium as high as 70%. Very recently, it's come back a bit to 66% vis-a-vis other emerging markets, and that is very close to the highest that's been in 10 years. Now, that's broken off a 7-year range. So that's another flashpoint.
Lastly, Ravil, on fund flows, does that repose confidence? Does it tie in with the overall story or not?
Well, they continue to be positive, and they've been a huge buffer going past 2 years. Every time there's been a global shock, you had local mutual funds stepping in and preventing the Sensex from kind of giving way. But at the margin, the last 2 months, we've seen a distinct sign of them slowing off. We're still doing a monthly hurdle rate, run rate of about $1.4 billion for the past 3 months, but that's come from as high as $3 billion in the preceding 6 months. So at the margin, they are slowing down because of the volatility elsewhere. So it's a space you need to watch.
Well, thank you so much for joining us with your views.
Thank you.
All right, let's move on. August saw automakers tread different paths as far as the monthly sales are concerned. While a high base finally played catch up with Maruti Suzuki and Hero MotoCorp, others like Bajaj Auto rode on the slew of new launches in the recent past. Yash Upadhyay is here with the details. Yash.
Absolutely, Iran. It's not just the high base, but also the fact that the festive season is delayed, as well as severe floods in the southern region that has impacted sales in August. So India's largest car maker, Maruti Suzuki, was a casualty of this. It reported a 3.5% degrowth in their sales, coming in at about 158,000 units, significantly lower than the Bloomberg Quint poll of 172,000 units. Hero MotoCorp, a flattish month, about just a 1% growth on a year-on-year basis for them. Eicher Motors being another player which has a sizable portion of its sales coming from the south region, as well as the delay in their new launches. They saw only about a 2% growth in volume, coming in at about 69,400 units, which is again significantly lower than the Bloomberg Quint poll of 75,000 units. However, on the other hand, Bajaj Auto and TVS Motors, they did fairly well for themselves. So Bajaj Auto posted about a strong 27% growth in the domestic sales for its motorcycle business. The commercial vehicle sales also did very well. Exports are picking up for the company. TVS Motors, that posted a strong quarter, 8% growth for its total sales, coming in at about 340,000 units, largely in line with the Bloomberg Quint poll of 338,000 units.
Walk us through what happened in the commercial vehicle space and tractor makers as well.
So the commercial vehicle space was the one to watch out for, because all the three players have posted strong numbers there. So Ashok Leyland, they posted about a 27% growth in their total sales, with strong growth in the MHCV and LCV space. In fact, the MHCV sales came in much higher than the analyst expectations also, and with a total number of about 17,400 units, again much higher than the Bloomberg Quint poll of 15,700 units. Tata Motors, strong growth in the commercial vehicles business, posted a 26% growth. But key to note here is that the passenger vehicle business also did fairly well, about a 28% growth for them, as well as the export market looking fairly good. M&M Auto, the passenger vehicle business was flat on a year-on-year basis, but the commercial vehicle business, that is the key over here, that posted a strong 25% growth from August of last year, and a total number coming in at about 48,400 units, almost in line with the Bloomberg Quint poll of 48,500. The tractor business wasn't that impressive. They sold about 16,400 units, which was lower than what we were working with, about 20,500. But Escorts also, they came out with a good set of numbers, 4.5% growth for them, about 4,800 units sold in August.
All right, thanks, Yash, for that. The Supreme Court has banned construction in 3 states in a union territory till at least the 9th of October. The apex court has cited the lack of a proper policy to deal with solid waste in Maharashtra, Madhya Pradesh, Uttarakhand and Chandigarh for passing such an order. Neeraj Shah spoke to some industry experts and explaining the ramifications. Neeraj.
Hey, so yeah, the news is precisely that the construction ban in 3 states and 1 union territory. That's the order that came in over the weekend, and the details I don't know about why it's happened. Now, you know, clarity is still needed, guys, on a couple of things. So one is whether the ban entails construction, all construction, or only new construction. Now, you will hear them. The couple of people that we spoke to said that they, having read the order, believe that it was across the board. But when I spoke to a few industry players off the record, they mentioned that as far as real estate goes, the old projects are still continuing. It's only the new projects that are being shut down for now. So there's a bit of a debate out there, and people themselves are not clear. It's an interpretation that they have. Whether the ban entails only real estate or other infrastructure projects. Now, again, Niranjan Hiranandani said that there is no bifurcation as per the order, but infrastructure players that we spoke to mentioned that their projects, they have not been told to do anything, and their projects are continuing. So infrastructure projects, according to them, in Mumbai and Maharashtra are still continuing. So a couple of points of clarity needed out here as well. And I'll get to the importance of that as well. Firstly, what are the key losers if this ban continues? I think cement players, by and large, even cement companies have said that if this were to happen, and even if Maharashtra were to chain and, you know, appeal against this, and that state may go out, the other states, Madhya Pradesh, for example, fairly high cement consumer companies like Dalmia Bharat, etc., so they get impacted. So cement players are one set of companies. Steel companies, predominantly manufacturers of long products, would get impacted. Now, while this is common knowledge as well, we spoke to the management of Godari Power and Ispat, and they mentioned that their company may not get impacted, but according to them, it's the long players predominantly which will get impacted in a big way. And I think everybody, if this ban were to continue, companies from tile makers to pipe makers to electrical product manufacturers would all stand to get impacted. Now, what's the chink, or what's the the piece to note or piece to monitor? The Times of India in yesterday's edition mentioned that the Maharashtra government is going to approach the Supreme Court for a stay on the construction ban order tomorrow. Today the courts are shut, so tomorrow essentially. And Mayfair Housing, Nayan Shah, he's the president of CREDA as well, who spoke to us in the morning along with Niranjan Hiranandani, mentioned that this is
cross harbour construction. It talks about all the constructions put together. Remember, the state government in Mumbai region alone is doing 2 lakh crores worth of infrastructure in terms of doing it. Building and housing industry would be another 2 lakh crores of rupees of construction activity, including affordable housing segment that we are talking about. And the worst of it all, 4 lakh workers are there in this region who are working on these projects. If the work stops for 30 days, 4 lakh people will not get wages on the 1st of October next month. It's a scary proposition. Believe you, all the rest of the things put together, and this one question of labor not getting wages next month is really horrendous. I mean, it'll be worse than a tsunami. So I think it's a very strong order, maybe a correct order in terms of saying that I want to put the states into the job and do it quickly. But remember, Maharashtra has come up with a clarification which appears to be something which was not communicated to the Supreme Court. And number two, Nayan Shah, who is with me, will tell you about that already. CREDAI has already obtained an order under the same position of solid waste management for housing construction, where another bench of the Supreme Court has given a go-ahead to the construction on the same issue of solid waste management. So scary, scary, scary.
It is indeed, and that's what the view was of all the people. But okay, since Mr. Hirandani mentioned Nayan Shah and telling us about the order that CREDAI has obtained as well, let's get him into this discussion. He's the president of CREDAI. Mr. Shah, good having you. Thanks so much for joining in. What's your sense, Mr. Shah? I mean, again, I think the same question firstly. I think Mr. Hirandani has made it aptly clear that according to the order that, and in the way he's perceived it, there is no distinction between old and new construction and no distinction between real estate or infra. Part one of my question is that. Part two of my question is something that Mr. Hirandani was referring to, that CREDAI has obtained an order pertaining to some bit of construction activity. Can you brief us on that as well?
Hi. First of all, I would like to tell you that there is no need to panic. There is no need to panic at all. See, this is a technical glitch which has happened. The solid waste management policy was always, in fact, Maharashtra was always leading the whole country. It's just that, what has happened is that the affidavit, I am told, was ready, the draft affidavit was ready, and the Supreme Court, the date for the hearing was preponed. And this really took the advocate representing government of Maharashtra, they were not ready for it, and the necessary officer probably was not available to file the affidavit, and hence this delay happened, and it cascaded into this kind of an order. So, as I know very clearly that tomorrow morning, in fact, the government of Maharashtra would have done it today, but unfortunately, Honorable Supreme Court is closed today for Janmashtami. Tomorrow morning, the first thing, they are filing the affidavit. They are putting up the, policy note before the Honorable Supreme Court. And I think it's a matter of 1 or 2 days that, this stay, technical stay, I would say, would be lifted.
Okay, that's a discussion on the real estate sector. 3 years into bad loan cleanup drive, and resolution still remains a distant dream. Just this month, 60 stressed accounts thrown up by the Reserve Bank of India's February 12th circular is likely to go up to insolvency. Add to that, 40 accounts have already been referred by the Reserve Bank of India, and 7.5 lakh crore in bad loans are under risk. Vishwanath Nair gives us a status check of what's going on.
Right, Harsha. So, as you discussed, the February 12th circular has thrown up about 60 new cases to the original 40 that were part of the tool list that the Reserve Bank put out last year. So that makes about 100 cases, and the debt involved is closer to 7.5 lakh crore. So huge amount stuck within the insolvency courts. And the reason we are saying that resolution is still a distant dream is it'll show up in this chart. See, this chart shows what has happened with this, the first two lists of the Reserve Bank of India. This of course, a select number of cases. This data was collated by Debtwire, a news agency. And if you can see, about 18 of them till about this point here, 18 of them have already crossed the 180-day deadline that is part of the IBC. Remember that that's the first deadline that the creditors and the NCLT is supposed to work with. In case the case is not resolved within 180 days, the NCLT is allowed to extend this period to 270. But even there, if you see, a majority of them, about 13 of them have already crossed the 270-day deadline, which means that close to a year has already passed since these two lists were put out, and resolution is still nowhere near closure. You can see that some of these have liquidation orders, and about 4 or 5 of them have already been completed, but a majority of them still remain without any kind of resolution. So this shows you pretty much as to what is going to happen to cases once they reach the NCLT, these 60 cases that we're talking about. Important also to note is that over the last 2 years, the bankers have been able to show some kind of resolution, some kind of recovery from their books using their own recovery tools. Just this during the June quarter, we saw that recoveries have actually outpaced the write-offs in the sector, in the banking sector. This is the first time in 1 year that this has happened. So that's an important distinction to make, that banks are making some headway there. But by and large, if you depend just on the NCLT to resolve all of your bad loans, then that is probably not going to lead to any recovery before 12 to 18 months have passed. That is by FY20, largely. That is at least what the analysts are estimating.
I think the two-part to that is that the NCLT resolutions are taking time. There is some hope coming in from the recoveries and upgrades which have picked up, but the big accounts, perhaps resolution still 12 to 18 months away. Thanks so much for that, Vishnath. Let's move on. Now, Reliance Industries made history just a few days back, becoming the first Indian stock to cross the rupees 8 lakh crore market cap. That makes it one of the most valuable companies in the world. But what does it do to its valuations, and how does it stack up against its global peers in the oil and gas space? Somit Sarkar standing by with that answer. Somit.
So now there are only 103 companies in the world which have a market capitalization of more than $100 billion, of which 8 companies belong to the oil and gas space. And of these 8 companies, Reliance Industries has risen the most. It has increased nearly 40% in 2018. And this rally in the share prices of Reliance Industries has now made it the world's most expensive oil and gas stock. Now, I'm just showing here the price to earnings ratio, but if you even check the other valuation metrics, that is the EV to EBITDA and price to book, it is expensive on those metrics also. Now, on PE, if you see on consolidated basis, the 12-month forward PE for Reliance Industries is nearly 16.7 times, while the standalone PE is close to 18.3 times. Now, this compared to its 5-year average, which is close to 12.3 times, and peers like Exxon and PetroChina, which trade at 15.4 times and 14.9 times. Now, if you see the share price chart of Reliance Industries, you can clearly see that most of this surge has come in the last 2 months, that is in July and August. Company's market cap has risen from nearly 6 lakh crore to close to 8 lakh crore rupees, and this new leg of rally has made Reliance Industries the most expensive oil and gas stock in the world.
So what's fueling the rally?
So first thing is the strong Q1 numbers reported by Reliance Industries. Now I won't dwell much into the numbers, but just few highlights from those numbers. Now the standalone EBITDA of Reliance Industries increased 13% in Q1 compared to last quarter, which was the highest Q-on-Q rise seen by Reliance Industries in the last 13 quarters. Now this 13% rise has not only confirmed but also increased the investor expectations of robust energy segment performance going forward. Now second was the retail business. Now, the retail business reported its highest ever EBIT and EBIT margins in Q1. Now earlier this segment was underperforming, but given the current consistent performance from the retail segment, investors have now started to give a higher valuation to this business segment of Reliance Industries. And lastly, it was Reliance Jio. Now despite tariff wars, the profit and margins of Reliance Jio have been consistently rising, and this has led to this new rally. Now along with this, if you see, Reliance Jio has also entered the home broadband and the DTH space. Now this has increased the investor optimism on Reliance Jio's business after the recent success of its telecom venture. Now sticking with the telecom business, there were 2 recent data numbers that came in July and August. First was the subscriber number and second was the revenue market share. If you see in subscriber number, Reliance Jio added nearly 1.9 crore subscribers, which was the highest among its peers, and its revenue market share increased to 22.6 from 11.6% reported by the company in the very first quarter when it reported its financials. And lastly, on the energy segment, if you see the refining business, now of late that segment was a bit subdued for Reliance Industries, but given the recent strength in Singapore gross refining margin, the outlook has improved for that business segment also. Now Singapore gross refining margin, which is the Asian benchmark, now that averaged around $6.8 per barrel in August 2018 versus $4.8 per barrel in June 2018. Now higher gross refining margin means a higher earnings for the refiner. Now as for Reliance Industries, especially if you see, ramping up of their new plants will also add another $1.5 to $2 per barrel in their gross refining margin, which has increased the earnings outlook when it comes to refining business. So to sum it up, it is a strong earnings, positive expectation on the telecom business, strong earnings outlook on the old lagas, that is the refining and the retail business, and outperformance of Jio that has fueled the new rally in Reliance Industries share price.
Shravan, thank you for that. US President Donald Trump is ready to take the trade war with China to the next level. Sources tell Bloomberg News that Trump plans to follow through on a threat to impose tariff of another $200 billion of Chinese goods. That would mean that more than half of all Chinese imports would be subject to tariff. Stephen Engel reports.
In 2 months' time from now are the midterm elections, so you're likely to hear an amped-up rhetoric coming from the White House as he wins political points in his mind for being tough on China. So this threat of another, round of tariffs on $200 billion worth of Chinese imports plays to that narrative among the hawks in the White House. If you think that it's a battle of the two camps in the White House between the likes of the USTR's Robert Lighthizer and the trade advisor Peter Navarro versus more moderates like Steve Mnuchin at the Treasury Department and also the economic advisor Larry Kudlow, it seems as though the Lighthizer-Navarro team are kind of winning out on the narrative right now. So Trump is said to be announcing an imposition of more tariffs on some $200 billion once that consultation ends this Thursday, so that could be Friday morning Asia time. China has said or indicated it could respond with duties of its own on some $60 billion worth of U.S. imports. But it's going to be a very pivotal week, obviously, whether this amps up into more of a trade war, given the fact that there are no negotiations planned at all.
Stephen Engel there. Out of time on the show. Thank you so much for joining us today.
Stay tuned to Bloomberg Quint.